So it was quite surprising that this last week they picked about so this week they picked 100%. What was that?
Okay.
It's I think it's a cyclical. I mean, it's July. Typically, with the beginning of the fiscal year, and typically July tends to be a dry month for the government in terms of liquidity.
Yeah.
So I think we're likely to see from July, August, we're likely to see the central bank picking up a lot everything.
Okay.
I don't expect them to be very choosy. Maybe from towards when the tax starts, liquidity starts trickling in the government accounts. Maybe towards September. Now, for now, I think especially for the month of July,
just expect them to keep popping up liquidity from the market.
I expect them to pick up strongly.
Okay.
The bids.
But also this July, I think the market expects the highest level of redemptions. I've seen numbers 133
That's a big factor
billion.
in this, yeah.
I've seen numbers 164 billion. I mean, this is the highest level we've seen in a while. So could you explain why they're taking all the money that they can, because they really don't have money. They don't have the option at this point.
The redemption is a big issue, because I saw figures of 154 billion.
I've seen from 133 to about 164 billion.
That's coming up this month.
Yes.
That's a lot.
That's a lot of money.
That's a lot of money.
That's a lot of money, George.
And I expect them, actually, you should look at for the July bond auction, the primary auction that is coming up.
Okay.
I think that
this is the 40.
This is the 15-year.
The 15-year 40 billion.
Yeah, the 40 billion. I still expect. I mean, the market is still liquid. I still expect a strong performance in excess of 100%. But then I equally expect that the central bank will pick a lot of it.
So this month, because typically every week during the T-bill auctions, the government collects about 25 billion, which puts it at 100 billion for the month. But this week it's almost double that, 44 billion. Yeah. So if you use this as a run rate, I mean, if you say maybe about 50 billion every week, then the government could potentially collect over 200 billion in this 1 month alone.
Yeah. Remember, the market is also very liquid. Where is interbank? Is the market still below 2%?
Yes.
The market is still super liquid, absolutely liquid. And the problem is when you have such a liquid system, some of those money ends up in the FX market, and that's why we are seeing the sustained weakening in the Kenyan shilling against the USD.
Okay.
We are now doing about 104, close to 104 actually. Yesterday I was speaking to a treasurer and it was 103.7.
Okay. Wow, that's pretty steep. 103. Okay,
it's actually almost inching towards 104.
That's a bit.
And the best strategy that came out from a conversation yesterday is that the central bank has to continually withdraw liquidity.
Yes.
And local currency liquidity, because a lot of this liquidity is being used to fund positions in the FX market, and it's very cheap now to fund positions in the FX market. When you have interbank below 2%, it's very cheap to fund your position. You can actually go short, you can go long on the dollar, and you fund at 2%. The best thing is pull out some of those liquidity. How do you help pull out some of those liquidities? You have the open market operations, the TADs. The central bank is using TAD, the term auction deposits, which is another monetary open market operations instrument that they use to withdraw liquidity. The term auction deposit. They're actually issuing 28-day term auction deposit.
Okay.
At about 5%.
So this excessive liquidity.
Yeah.
I mean, what's the implication if you're a fixed income investor for the second half of the year? So if you're getting your 3-month paper at 6%, 6.06%. How will that look like in September?
When you're getting a 1-year paper at just below 9%.
Exactly. So how is that going to look like in a year's time? That's really the question. I mean, it's one thing as an investor, you don't have the option because you have the money. Then do we begin to see the domestic investors beginning to put their money into the equity market rather than taking a 6% return for the full year?
Yeah. So typically the equity market and the fixed income market play on the opposite ends.
Okay.
When the interest rates go up, when there's an upward jerk in interest rates, equity market tends to underperform. When interest rates come down, then you still see a strong performance on the equity market. So I expect that investors, because the problem looks at fixed income instruments, when you start talking about 15-year bond coming in below 12%, then fixed income instruments become very unattractive.
Actually, the 3-year
was perspective.
The 364 day was 8.64%.
Yes.
Okay.
Then what you have now, you have a flight from fixed income to equities. So that's typically a very cyclical play when portfolio managers try to balance out the declining returns in the fixed income market, try to substitute it with equities, and now you have a new asset class which is in the derivative. So you probably should expect some of this, a little bit of not excessive, but a bit of flight into the derivatives market. But
derivatives or equities, because I would imagine, I mean, if I'm seated, one element of looking at this rates, if your 15-year is giving you And not your 15-year. This is, yes, the current ongoing auction is a 15-year
Yeah.
primary bond that closes on the 23rd of this month.
Yeah.
And we've seen people talking about 12%, give or take a few basis points.
Yeah.
Maybe 12%, 12.1%. So your 15-year is 12.1%, which means your 5-year is certainly way below that. And if I'm looking at the cost of equity, which is my discounting factor on the equities, whereas before I was at a higher level, now I'm at a lower level. And based on that element alone, then you would expect people to be able to pay slightly higher prices on the equity market. So if I'm not getting a substantial return on the fixed income market, as a local domestic holder, I'm expecting redemptions in this July alone, about 150, 160, whatever amount is going to come back to the market. Does it even make sense to redeploy it into fixed income? Why don't you just come and take positions like the banks? The banks, when they were about 38 shillings, they do make sense for you because you can easily get your 6-10% return on the equities alongside the dividend return.
Yeah, but remember the portfolio managers have a quarterly reporting, so they have they have to deliver alpha on a quarterly basis.
But you can't deliver alpha on a quarterly basis if you get a redemption this month and redeploy it to fixed income.
Yeah, that's the problem. You know, when you have about 150 billion shillings, well, it could be from 130 to 160 billion shillings.
But of course, it's
coming into the market.
It's distributed.
Yes, you have but that's actually, you raise a very important point. Actually, you have about 150 billion shillings that is going to come into the market. Yeah, this is liquidity that's going to look for home. Yeah, so then we go back to the supply-demand equation. You got demand, we're going to outstrip supply. Then that means that the yields are going to be driven down because then you have about 150 billion chasing for a few years. So then I still see the yield environment coming down. And that's not very good news even for banks that have, for the last 2 years, have been only having one asset allocation strategy, is to buy treasury bills and treasury bonds.
But you see that the banks don't have the option, as the fund managers do, of the fixed income market as well as the equities market.
No, but the banks are not set up to buy treasury bonds and treasury bills.
No, but they do that for their own books and they're managing liquidity.
Yeah, but look at, for the last 2 years, banks have not been giving out credit.
They've been putting their money in government securities.
Yes.
But what I'm saying, George, you see, if today the 150 billion comes back to the market, right? When you look at the debt structure, I think the banks own a larger volume. It's 50. It's a 50-50.
Yes.
So fine.
Yes.
You say from the 150, 75 billion goes back to the banks. That for sure, will go back into the fixed income market.
But that's what I'm saying.
75 billion now goes to the insurance companies and the fund managers who have the option of either going back to fixed income or equity.
But that's what I'm saying. If yields keep coming down,
then you want to go back to equities.
But for banks, if yields keep coming down, then how do you drive your earnings? If let's say the 15-year, for instance, this auction, 15-year comes in without that heavy liquidity coming in the market through redemptions.
Actually, it could even come in below 12 because there's now 150 that's lying around there.
If it comes below 12% for a 15-year bond, does it make sense from a bank earnings perspective? Would you rather just lend them?
Do you know what that tells me? CBK.
Because you can lend at 2-year money. Banks can lend 2-year money at 13%.
Well, that tells me, George, CBK and Treasury are sitting in a very good place. Because from the discussions we've had, fiscal deficit, they intend to raise about 300 billion from the domestic market. If we use 44 billion from the Treasury auction as a run rate, if the government wanted, they could be able to meet the 300 billion mark in 2 months, July and August alone.
Yeah,
with the liquidity that's there and push prices down.
But that domestic borrowing target, it also includes redemption, so it's a net. That means I need to actually borrow more.
Okay.
Because you also have.
Okay, that's a good point. I had not factored that into my assessment.
So you have to. That means you have to
probably
borrow about 500 billion shillings.
Okay.
Yeah.
So they can.
I think they also have to be. But the point is that they also have to be very careful, not to. They've sent out a message of crowding out over the last few months.
Okay.
But I think they have to be very careful also not to send a very wrong signal to the market that we're desperate for cash. You know. So they have to also be very careful. They have to apply very delicate balancing act on this market. Otherwise, sometimes they send the wrong signal. Okay. It's all about signaling.
Yes. But maybe we can ask our graphics team to put up this auction results just for our viewers to be able to see. Because I think when you look at the 364-day at 8.6, yesterday, George, we discussed real estate. 12% return in Westlands, if you're lucky. So as an investor, you're getting from a point 1 year, I can get an 8.6 from the government. I can get 8 to 9% with regards to a dividend yield from the banking stocks. I can get 12% from the real estate sector, depending on the risk that I want
I
to
think
sit on.
I don't want to put the real estate sector, which for me is a totally different asset class. I don't want to put them in the same basket because they have different.
No, I'm not putting them in the what I'm looking at. I'm saying today, as a portfolio manager, if I have 100 million and say maybe out of this 75 billion, 10 billion comes back to me, I have to look at a range of investment opportunities. I have an opportunity with the government, depending on what 10 I want to get into. So you have your government 1 year, 364 day is giving you 8.64%. I'll probably pull down the yield curve and see would you know where the 5 year is?
The 5 year should be about around 10%.
10%. Okay, fine. Let's go with the 10% figure. So 5 year, 10%. And then you come and say that an apartment in Westlands, and maybe this is not the right benchmark, but just to illustrate, this is an asset that can give you 12%. Then you come back to the stock market and you say, I can get a dividend yield of 8%, unless it gets better. So you have to be able to see, but then how am I allocating this money? Because by the end of the day, I'm chasing a return. Do I still keep giving it to the government with the effect of having lower returns from the government as we keep going along? Do I see an opportunity in some select stocks on the equity market? Or do I want to get into real estate? Because even in this whole week, we've seen pension funds actually laying groundwork to start buying space and set up commercial buildings. Because is that something that they're saying? We actually see better returns in the real estate sector that are sustainable and are lower risk, rather than putting all our money in fixed income and getting lower returns as the yield curve corrects.
No,
Not even corrects, continues on
I think for asset
slide.
allocators and asset managers, the asset allocation decisions are driven by trilemma, that you have to balance between capital preservation, returns, and liquidity. So you're talking about, for instance, real estate. There's a huge liquidity discount that comes with it.
That's true.
That allocation.
That's very true.
So if, for instance, some of the asset allocators, pension fund managers, who are primarily managing insurance money, and yesterday I said this,
insurance or pension money?
Yeah.
And pension.
Yeah.
Insurance and pension money.
Insurance and pension money.
Okay.
But there's also an insurance money in this, right?
Okay.
So you take take the life products, you're buying a 15-year policy.
Okay.
Yeah. And then you invest on the yield
But the
curve.
majority is general. Okay, hold on to that thought. Let's take a quick break. The NSC opening bell, look out for that. See you shortly.